Joining me today to discuss some recent research regarding the use of listed REITs in conjunction with private real estate equity funds is Michael Gruppi, NAREIT's Executive Vice President of Research and Investor Outreach. Michael, Morningstar's latest research shows that publicly traded equity REITs have outperformed private equity real estate funds consistently over the long term, all while experiencing stronger bull markets, recovering faster from downturns, and having lower fees from expenses. Now, these points are all in line with NAREIT's communications with the investment community, and I'd like to drill down just a bit more if we could. What did the research show regarding long-term performance comparisons?
Yes, Matt, the research revealed some very interesting comparisons using data that has become available only in recent years. Prior to the introduction of these additional data, investors only had the option of comparing publicly traded REIT returns with asset value returns as reported by the NCREIF Property Index, or the NPI. One of the challenges with that comparison is that the NPI, although it's a very large and comprehensive database of property valuations and returns, is not really an investable index. A few years ago, however, NCREIF, in conjunction with the Townsend Group, began to make available actual reported investment returns for core funds, value-added funds, and opportunistic funds. And so for the first time, investors had the opportunity to compare returns to both publicly traded equity REITs and direct investment platforms through indexes of real investment experience. And the data cover approximately the last 20 years or so. And what they reveal is that, as you noted, fairly consistently over that period of time, total returns to equity REITs, net of fees and expenses, exceeded comparable returns for core funds, value-added funds, and opportunity funds.
And what did Morningstar's research reveal regarding fees related to these investments?
Well, that's a very interesting point, because we often compare gross investment returns for different types of investments in both the equity markets and the fixed income markets, as well as the real estate markets. But of course, from the investor's perspective, the real interesting and relevant question is, how do your investments compare in terms of their returns net of those fees and expenses? And what the Morningstar research reveals, using the data available from NCREIF and Townsend, is that the fees and expenses to publicly traded equity REITs are significantly lower than the total fees and expenses available through these alternative direct investment platforms. That's not entirely surprising. A significant body of research over the years has revealed that same relationship. But the Townsend data give us a little more precision in terms of what the level of those fees and expenses have been.
And the credit crisis really brought to light the use of leverage, and we've heard a lot about that. What did Morningstar's report show regarding leverage?
Well, the interesting conclusion from the research is it revolves around the widely held view in the investment marketplace that less liquid investments, investments that use more leverage, typically provide higher returns on equity. And what the data actually reveal that through Morningstar's analysis is that even though the level of leverage among the different direct investment platforms is generally higher than that for an investment in equity REITs, the returns to the listed equity REITs were still significantly higher. Although the returns to core funds, the leverage that's used in the core funds generally is less than the leverage used in equity REITs, whereas the leverage used by value-added funds and opportunity funds is greater. That added leverage does not appear to have contributed to the higher returns that one might have expected. And that's what the interesting prospect that the research reveals, and the question that it raises for investors is, are you being accurately and adequately compensated for the additional amount of leverage that's used in the investment platform?
And lastly, the research is obviously very, very compelling, but what should investors do with it?
Well, our view is that now that the investment community has these additional data available, it invites additional analysis and comparison. And investors should take advantage of the opportunity to refine their analysis of competing real estate investments. And when they do so, to consider the fact that compared to many of the direct investment platforms that they've grown accustomed to, that they're familiar with, that they're used to using for investing their real estate allocations, that there is a viable publicly traded market through REITs to provide a very competitive alternative. And that alternative not only appears to provide higher returns over these long investment horizons, but it also provides an element of additional transparency. It provides a critical additional element for liquidity, and it provides a diversification benefit because the benchmarks that are used to measure performance in these various investment platforms, both public and private, are not perfectly synchronized. And so that helps to provide additional sources of diversification in the portfolio overall, as well as in the real estate portfolio. And it simply creates an opportunity for investors to improve the overall returns, to manage the risk more effectively in their real estate portfolios by having a more even balance in their real estate allocations between direct investment programs and publicly traded equity REITs.
Michael, thank you very much for joining us.
You're most welcome, Matt.
For a copy of Morningstar's latest research, be sure to visit REIT.com, as well as for other REIT news and analysis. I'm Matt Bishar.